natural gas prices edged higher in early Friday trading as the market begins positioning for the upcoming rollover to the July contract, with the June contract set to expire on May 28. This transition typically occurs a few days prior to expiration, and in this case, the most likely date for the rollover impact is Friday, May 23, the last full trading session before the U.S. Memorial Day holiday weekend. During this rollover, front-month pricing shifts from the June contract, currently trading around $3.30, to the July contract, which holds a notable premium near $3.72. This 40-cent spread reflects bullish expectations for midsummer demand, weather-driven consumption, or potential storage tightness. The rollover-induced price shift doesn't imply an immediate market rally, instead, it marks a change in contract reference. If the July contract begins to decline post-rollover, it would suggest a re-evaluation of these bullish assumptions. Traders should therefore watch not just the rollover date, but also how well July holds its premium as it becomes the front-month benchmark. Meanwhile, weather continues to weigh on natural gas demand. The latest 7-day forecast indicates below-average temperatures across the Midwest and East, with widespread highs ranging from the 50s to 70s and even cooler spots in some areas. Although the West and South remain hot, robust solar generation is curbing the need for gas-fired power. As a result, overall U.S. demand is projected to stay light, limiting the potential for any short-term bullish momentum. Adding to the bearish sentiment, spot prices in the Permian Basin have turned negative, signaling a regional oversupply and ongoing constraints in takeaway capacity. Nationwide production remains strong, holding above 105 billion cubic feet per day, which continues to weigh on both regional hubs and benchmark pricing. With output steady and infrastructure bottlenecks unresolved, localized price collapses are beginning to influence broader market sentiment. Meanwhile, today's update projects that natural gas inventories will increase by 389 billion cubic feet over the 4-week period from May 17 to June 13, which is 33 billion cubic feet above the 5-year average and reinforces a bearish outlook. If this projection holds, total storage would rise to 2,764 billion cubic feet, expanding the current surplus versus the 5-year average from 85 billion cubic feet to 118 billion cubic feet. Should this trend continue, it may lead to another downside correction in futures prices, potentially narrowing the existing overvaluation gap, which currently averages around 27%, and bringing prices closer to fair value. From a technical perspective, with inventories rising quickly, demand remaining weak, and indicators signaling a potential breakdown, the short-term outlook remains bearish. A drop below the $3.20 support level could open the door to further declines, with downside targets at $3.10 and $3. Unless any rallies can break through resistance at $3.50 and the 50% retracement near $3.70, traders should remain cautious and brace for continued near-term weakness. Please like, subscribe, and comment to support the channel. See you in the next one.